Hey, you've started your business and you have some money, and now it's time to take it out and pay yourself. Awesome. That's great. There are some right ways to do it and wrong ways to do it. And in this video, we'll talk about 4 ways to help make sure you do it the right way. No matter how much passion you have helping others, at some point you need to get paid for your services. And some people have a tough time pricing themselves appropriately, and they undervalue themselves, especially early on in business. But nevertheless, eventually you will start to make money and be able to take some home and pay yourself. We actually help a lot of people with that at Origins Incubator. Our mentorship program over there is really comprehensive, but we cover a lot of this mindset stuff too. And not only do we help people kind of create their offer, create their offering for patients, what they're going to deliver, we also help them price it out so that they feel confident in saying the price out loud, because they know what they're giving is high value. And also it allows them to have a work-life balance and make sure that they can help keep their doors open, because if you underprice, you may go out of business. And as we like to say, you have to put on your own oxygen mask before helping others. So just because you make some money in your business doesn't mean you can't give away some scholarships or do some volunteering when you want to give some medical services away for free, or to underprivileged groups for a discount, or for a big group for a lower fee. You can do all of that. But the fun part is when you've got money and you need to pay yourself or want to pay yourself, because that can be the most fun part besides helping others in running a business. So here are 4 tips to withdraw cash from your business to pay yourself. Let's go. All right. For tax purposes, you may want to consult with a CPA. And I recommend CPAs because they pay for themselves in tax savings and lack of mistakes that you would make yourself. But let's get into it. I'm not a tax professional, but these are some tips that I picked up along the way, those that I follow myself. LLC is a pass-through taxation, same as sole proprietorships, same as partnerships. They're pass-through tax entities. You pay tax on profits whether you withdraw it or not. So let's say you've got profits and $100,000 are in your business bank account. We'll talk about using separate bank accounts in a second. You got $100,000 in there. Even if you never take that money out and put it in your own Bank of America account or personal checking account, you are still listed as having that profit for your business tax return and for your personal tax return as well. So whether or not it's sitting in your business bank account or you've moved it to your personal bank account, it's still profit. So that's something to keep in mind. Tip number 2, you should have separate bank accounts for your business and your personal fund. You should have a separate EIN, and this is what you do when you set up your business as an LLC or as a GC or any other kind of entity. You want to get an EIN, which is employer identification number with the IRS. It's free to get. It's effectively a social security number for your business, the tax ID number. Even though you may not have any employees yet, it's still called an employer identification number, or EIN. The reason why you want to have separate bank accounts is the number one reason is that it keeps you with the limited liability of the company. In other words, just because you have a company doesn't mean that your personal assets are 100% guaranteed to be protected. There's limited liability companies, but they're not zero liability companies, right? The business is still liable for those debts, but the biggest thing that would allow a court, and this does happen, to what lawyers call pierce the corporate veil, is commingling of funds. Let me break that sentence down for you a second. When a business has debt or when there's a judgment against the business, usually only the assets of the business can be attached to pay off that debt, right? So if the business only had, let's say, $100,000 and there's a judgment of $200,000, the business has a choice to either go bankrupt, come up with a payment plan, go out of business entirely. But one of the options is not grab the assets of the owner, cars, vacation homes, whatever else you have, bank accounts, 401ks of the owner, and then pay off the debt with that. So that's the limited liability of a corporation as well, but also a limited liability company. That's not bulletproof. And one of the ways that courts can reach through and pierce the veil, the corporate veil, is the most common way is commingling funds, or mixing personal funds and business funds, usually in the same account. Other ways that it is pierced, the corporate veil is pierced, is if you kind of pay for a lot of personal things out of your business account, pay for a lot of business things out of your personal account, and you don't keep good records for reimbursement. So the easiest way to avoid all of that, to have a bank account, a separate bank account, best if it's at a separate bank, but it doesn't need to be, for your business, and one for your personal funds. That also makes it a lot easier at the end of the year to keep track of your book, which you may be doing throughout the year as well. But when tax time comes, it's a lot easier to track your business expenditures versus your personal expenditures as well. Number 3, track owner withdrawals by check or EFT, electronic funds transfer, also called automated clearinghouse transfer, ACH. That helps create a paper trail. So owner draw or owner withdrawals are not the same as salary. Check with your CPA. At a certain point, if you're running the business and you're working in the business, you have to take a reasonable salary. What that reasonable amount is up to you and your CPA to kind of determine together. But owner withdrawals are not the same as salary. Salary goes through a payroll company, usually. You can use QuickBooks, that has a payroll add-on feature, but there are many, many third-party companies as well that will help you with payroll, or your CPA may have a payroll service as well. Those payments go through payroll, and you deduct some payroll taxes out of it as a business, and the employee deducts some payroll taxes out of that as well. They pay half of those. But tracking your owner withdrawals, owner pay, and here's the difference. I own stock in Apple. I don't work at Apple, so I don't draw salary from Apple, but I get some dividends every once in a while. I don't have a lot, but I get a few cents every quarter in dividends, right? I don't pay employment taxes on those dividends. And so similarly, the tax treatment between salary and owner withdrawals are different. So that's something to check with your CPA for as far as salary determination, what's a reasonable amount for you, and also being able to track those ownership distributions either by check or by electronic funds transfer. And then last but most important, definitely not least, is now that you have a business, if you're not taking 100% of your income through salary, and some of it is coming through ownership distributions, you need to set aside money for taxes. Preferably, if you put them in a different bank account, maybe at the same business bank account, same business bank, you just have 2 checking accounts and a saving account. And one of those checking accounts is just a tax holding account. How much? Generally, people recommend 10 to 15% of gross revenue be set aside into a tax account. If you set aside too much throughout the course of the year, guess what? You just gave yourself a tax refund, but the IRS didn't hold on to the money. You may, at a certain point in your business, start to have to pay quarterly estimated taxes, and so this account can work for that. But it can also just be a holding account for your March 15th, which is the business due date for tax return. It could just be your holding account and either make a payment at that point or to reassess how much you're withholding for next year. So if you were withholding 15% this year and you kept most of that, you didn't have to give money to Uncle Sam or as much as you thought, then you can maybe adjust that down to 12 or 10% next year. We actually use at our businesses, we use a system called Profit First based on the book of the same name by Mike McCallett. And we actually have about 5 bank accounts at each business. But all that, it sounds really complicated, but everybody that's ever adopted this system that I've spoken to says it's changed their life. So I recommend picking up a copy of this book and at least skimming it because it can be helpful to know where all your money is. In a nutshell, when money comes in, you allocate it to different buckets, and those buckets end up being different bank accounts at your business. So you put some money in operating costs, some money in ownership pay, which is profit first for you. You put some in taxes, and you put some in just like a slush fund. So this video is getting long, but this system has changed a lot of people's life and made it a lot more peaceful to handle the finances in their business. So I'll put a link to that as well. But that was 4 tips on how to pay yourself correctly as an owner. forgot to say I'm Scott Radigan. So I'm Scott Radigan. If you enjoyed this, hit subscribe, please, and check out the other videos that are appearing on your screen right now. Thanks.